In the last 48 hours of trading, the gold market flashed a number that shouldn't exist in a calm, well-functioning system. An exchange for physical cost around $60 per ounce. Not 6, not 16, around 60. In a market where people are taught that gold is the deepest, most liquid, safe asset on Earth, a $60 toll to turn a paper position into metal is the kind of figure that belongs to a crisis footnote, not a routine quote screen. And here's the part that breaks normal expectations. The headline spot price can look steady, even confident, while the conversion cost tells you the opposite story entirely. It's like watching a lake that looks glass smooth on the surface while the river underneath is ripping so fast it's chewing through the banks. They said this kind of split couldn't happen in modern markets. They said efficiency and arbitrage would erase it instantly. Yet in days, not months, not weeks, the plumbing signaled strain. That's the information gap that matters. Institutions don't wait for headlines. They watch the pipes. They watch the margins. They watch where the bars are and where the bars are not. And when those signals flash, the move is already underway by the time most people notice the chart. What I'm about to lay out isn't a rumor. It isn't a vibe. It's a set of measurable signals, risk controls, vault math, and demand shifts that point to one simple idea. Physical demand can front-run spot. And when it does, the spot price eventually has to reconcile with reality. Welcome to Signal and Story, where we decode what matters before its headlines. If you've been here before, you already know the goal isn't noise, it's clarity. If you're new, consider this like listening to a wise elder who's seen the cycle repeat. The big. Moves leave fingerprints. And before we get into it, drop a quick comment telling me where you're watching from. It helps more than you think. Now let's start with what actually happened with dates and mechanics, not vague talk. In early February 2026, the Shanghai Gold Exchange made 2 risk control moves in rapid succession. On February 4th, margin requirements on key gold contracts were raised from 16% to 17%, and the daily price limit was widened from 15% to 16%. Then, almost immediately, another step followed. Effective February 9th, margin was raised again from 17% to 18%, and the price limit widened again from 16% to 17%. 99 was lifted from 120,000 Yen per lot to 150,000 Yen per lot. That is not a casual adjustment. Exchanges don't raise margins twice in a week because everything is fine. Margin is the market's pressure valve. When an exchange increases it, the message is simple. Volatility risk is rising, leverage is being constrained, and the exchange is preparing for fast moves. Widening price limits is another tell. It's an admission that normal guardrails might not hold. At the same time, in the West, the paper-to-physical conversion cost signaled a different kind of stress. The EFP, exchange for physical, reflects the spread in cost involved in shifting exposure between futures and the physical market. When that figure spikes to extreme levels, it's a symptom. Either physical supply is tight in the location and form demanded, or the channels to move metal are clogged, or both. A $60 EFP is not the market whispering. It's the market raising its voice. Here's the central mystery. If gold is liquid, if inventory exists, if arbitrage is smooth, why does it suddenly become expensive to turn paper into physical at scale? Why would an exchange in Asia be tightening risk controls, while conversion costs in Western hubs suggest delivery friction? To answer that, you have to step back and recognize a pattern that repeats across decades with different costumes but the same choreography. In 2008, the world learned a brutal lesson. Liquidity can vanish exactly when everyone assumes it will be there. The result wasn't just price swings, it was a repricing of trust. In 2011, another version appeared. As investors crowded into perceived safety, volatility rose, and exchanges responded with margin changes that forced leveraged positions to shrink. The result was not a straight line. It was a series of violent reconciliations between paper expectations and real demand. In 2020, the pattern showed up again in a new form. Logistics, refinery capacity, and transportation disruptions created a strange situation, futures. And physical prices diverged, premiums shifted, and the cost of moving metal across locations mattered more than most people had ever considered. The takeaway was clear. Gold isn't just a ticker symbol. It's bars in specific vaults with specific chains of custody subject to real-world constraints. Now look at the current year and ask, do we see the same playbook? In late 1979 and early 1980, the public story became about price, but the internal story was about access and credibility. Dealers described widening spreads and frantic sourcing as demand surged faster than distribution could handle. The result was not just higher prices, but a temporary breakdown in the ease of transacting. That same segmentation is what EFP stress represents today. On paper, a futures contract is exposure. In practice, delivery is a process. It involves specific bars, approved vaults, transport, insurance, and timing windows. Each step has a cost, and each cost can jump when the system is crowded. When conversion costs rise, it is often less about a single out-of-stock moment and more about a chain getting slower. If refineries are backlogged, bars can't be converted to the preferred form quickly. If transport becomes costly or constrained, location premiums widen. If financing conditions tighten, carrying metal becomes more expensive. The market responds by charging for immediacy. Now zoom in on how an exchange margin change can interact with that regime shift. A margin hike forces participants to post more collateral for the same notional exposure. If the market is moving quickly, the collateral demand can arrive exactly when participants are already cautious. The mechanical result is position compression. Some holders reduce exposure to free up cash. Liquidity thins. And when liquidity thins, price can move further on less volume, which then justifies the exchange's caution in a feedback loop. This is why the margin hikes in Shanghai matter beyond Shanghai. They are a signal about volatility expectations in a market where physical settlement is central. When margins go from 16 to 18%, it changes the cost of carrying positions for every participant who relies on leverage, even modest leverage. That doesn't tell you direction. It tells you the environment is tightening. And notice the timing coincidence with demand composition. When investment demand is rising sharply, the market becomes more sensitive to uncertainty and narrative shifts. ETF inflows can accelerate quickly during a risk event, drawing metal into custody channels and reducing marginal availability elsewhere. Central bank buying can continue steadily in the background, providing a persistent bid that doesn't vanish when sentiment calms for a week. Put together, it creates a floor under physical demand that paper traders can underestimate. So, when two markets speak at once, paper showing composure and physical signaling stress, the question becomes, which market has to adjust? Historically, paper adjusts more often than people assume, and it adjusts in bursts because it waits until friction becomes too expensive to ignore. First, the risk control move. When margins rise from 16 to 17 to 18% in days, the exchange is effectively raising the cost of carrying leveraged exposure. That forces some participants to reduce positions, not because their view changed, but because the collateral requirement did. This is a mechanism that can turn orderly positioning into forced selling or forced covering, depending on direction. It also deters new speculative leverage from piling in, which can amplify the influence of real demand on price discovery. Second, the demand composition shift. 3 tons of gold, a notable pace even though it was reported as down about 20% from the prior year. One country, Poland, bought 102 tons. At the same time, investment demand surged roughly 84% to 2,175 tons, with gold ETFs adding 801 tons across the year. That's a very specific kind of move. Demand expanding not just as a policy choice by central banks, but as a portfolio choice by investors. When investment demand accelerates, it doesn't always show up as immediate spot fireworks. Often, it appears first in the channels that service physical allocation, custody, and conversion, exactly where EFP and premiums live. Spot can lag because spot is a consensus quote. Physical demand is a flow. Third, the vault math. $467 trillion, representing roughly 732,649 bars. That sounds like an ocean of metal, and it is a large stock. This is the part no one is discussing. Vault totals are not the same as free float. A large portion of metal can be held against long-term allocations, central bank custody, or structured arrangements that aren't simply released because a spread widened. In other words, inventory can exist and still be functionally tight for the transaction that matters. Now add the east-west throughput picture. 98 kilograms, those are large numbers. They reflect active turnover in a market where physical delivery and domestic demand dynamics can carry different priorities than the paper, first systems many people watch. So we have 3 signals: a conversion cost spike around $60 per ounce, 99 margin from 120,000 to 150,000 Wen per lot, 3 tons. Put those together, and you get a picture that is less about a single day's candle and more about a market leaning into a new regime. Here's where it gets interesting. In healthy conditions, differences between paper and physical are supposed to be small and self-correcting. If physical is more expensive, traders deliver into that premium. If futures are richer, traders sell futures and hedge with physical, the gap narrows and the system returns to equilibrium. That's the theory. But the theory assumes frictionless movement, abundant deliverable supply, and participants willing and able to perform the arbitrage. In reality, those assumptions fail precisely when the market's temperature rises. Refinery constraints matter. Location matters. Bar size and specification matter. Financing costs matter. Even institutional risk limits matter. And when those frictions stack, a gap can persist long enough to become a signal, not noise. The dislocation, then, is simple to describe but powerful in meaning. One set of prices implies calm liquidity, while the cost to secure immediate physical exposure implies stress. Why can't that gap persist? Because a gap in a tightly watched benchmark market is an open invitation, until it isn't. Either the physical side loosens and the premium collapses, or the paper side is forced to adjust upward, or the system reduces demand and, through higher costs, higher margins, and rationing mechanisms. In every case, something gives. Now let's talk about the players, because markets don't move by abstraction. They move by institutions responding to incentives and constraints. On the exchange side, the Shanghai Gold Exchange is not just a venue, it's a risk manager. When it increases margins from 16 to 17 to 18%, it's responding to observed volatility and potential disorderly movement. The decision to widen price limits from 15 to 16 to 17% tells you they are preparing for larger daily ranges. That preparation changes behavior. It alters the cost of leverage and the probability of forced position changes. It also signals to larger participants that the exchange is prioritizing stability over maximum participation. On the vault side, London remains one of the most important nodes. The LBMA vault data provides a snapshot of the stock in London, but the existence of 9,158 tons doesn't guarantee ready availability. Think of it like a city with many apartments. The city can have hundreds of thousands of units, but on any given day, only a small fraction are actually for rent at market price. The rest are occupied, leased, or off-market. Inventory exists, but the marginal unit sets the price. On the demand side, central banks are the slow giants. 3 tons in a year is not a small number. It's a statement. Even if that pace is down about 20% from an unusually strong prior year, it remains historically significant. Poland buying 102 tons is an example of a single actor moving size that would be unimaginable for most private participants. Central banks don't chase intraday charts. They respond to reserve strategy, currency risk, and long horizon considerations. Their presence changes the baseline because it suggests a durable, less price-sensitive buyer. Then you have investment demand. When investment demand rises to 2,175 tons and ETFs add 801 tons, that's a broad behavioral shift. It means institutions and allocators are increasing exposure through vehicles that can drive physical sourcing behind the scenes. Even when an ETF is a financial instrument, the flows can translate into metal movements, custody adjustments, and tighter availability in specific channels. Finally, you have the arbitrage community. Banks, bullion dealers, and large traders who normally keep the system aligned. They are the ones who would typically compress a spread. But they are also subject to balance sheet constraints, capital rules, risk limits, and, in turbulent periods, the simple desire to avoid operational risk. When the environment becomes uncertain, the people who normally smooth the surface may step back. That's when the lake looks calm, but the current underneath grows stronger. Now, let's make the dislocation tangible with a simple analogy. Imagine a stadium where tickets are traded online. The listed price looks stable, but when you actually try to convert your digital ticket into a seat assignment at the gate, right? Now, for the most popular section, the fee explodes, not because the stadium doesn't exist, but because the specific seats that can be assigned instantly are limited, and the system is strained. The gate fee is the EFP, the listed price is spot. And when the gate fee jumps, it's telling you demand for immediate access is surging in a way the posted listing price hasn't absorbed. The Shanghai margin hikes are like the stadium requiring larger deposits from ticket brokers. It reduces speculative flipping and forces brokers to hold more capital to operate. That can cool some activity, but it can also reveal how serious the underlying demand is, because the participants who remain are the ones who can fund the trade. Now follow the chain of cause and effect. Step 1, demand accelerates in channels that require physical allocation or credible physical linkage. That can be central banks, institutions, or investors increasing allocations. Step 2, the marginal availability of deliverable metal in the needed form becomes more valuable. Step 3, conversion costs and premiums rise because the market is rationing access to immediacy. Step 4, exchanges respond by tightening risk controls, higher margins, and wider price limits because volatility and leverage are interacting with that tighter physical reality. Step 5, the tightening itself changes participant behavior, which can intensify the dislocation before it resolves. This is the part most people miss. Short-term price action is not always the same as underlying tightness. A system under stress can produce counterintuitive candles. The signal is not only the direction of spot. The signal is the cost and difficulty of turning exposure into delivery. So what does the evidence suggest right now? It suggests that physical demand is assertive enough to show up in the plumbing. The EFP spike around $60 per ounce is a measurable symptom of strain in conversion. 99 margin up from 120,000 to 150,000 yuan per lot show an exchange bracing for bigger moves. The vault data showing 9,158 tons in London and 732,649 bars shows there is stock, but stock doesn't eliminate tightness at the margin. 3 tons of central bank buying, 275 tons of investment demand, and 801 tons added by ETFs show that the bid is not theoretical. It is measured in thousands of tons. Now, historically, when you see this combination, conversion stress, tightening risk controls, and a demand mix shifting toward investment, three broad scenarios have tended to follow. In the conservative scenario, the system adapts. Premiums ease as logistics improve, arbitrage returns, and risk appetite stabilizes. The EFP compresses, and spot continues in a steadier trend with volatility subsiding. In this outcome, the signal was an early warning that conditions were tightening, but the market found a release valve without dramatic repricing. In the moderate scenario, volatility persists, and the market reprices in steps. Conversion costs and premiums remain elevated, forcing paper prices to adjust over time to reflect the marginal cost of securing physical. Exchanges continue to manage risk through margins. In this outcome, the reconciliation happens through a series of sharp moves and pauses, not a single event. In the aggressive scenario, the gap forces a rapid realignment. That can happen if a sudden wave of demand meets a moment of constrained deliverability, causing premiums and conversion costs to spike again, and spot to chase the physical reality in a compressed time window. This is not a guarantee, but it is a pattern the market has shown in past periods when stress concentrated in the delivery channels. So, what should be watched? Specifically, without turning this into prediction theater? Watch margins and price limits at major exchanges. When they change rapidly, it's the market's risk managers speaking. Watch conversion costs like EFP and any reported premiums for immediate delivery in key hubs. Watch official data on vault stocks, and more importantly, the changes in those stocks over time. And watch the composition of demand, whether investment flows continue to dominate, whether central bank buying remains steady, and whether ETF additions persist. Because the central truth is this: when physical demand leads, paper must eventually follow, or the system must find a way to ration that demand through higher costs and tighter leverage. There is no third option that lasts. When conversations shift from charts to settlement windows, from forecasts to sourcing, the market is revealing its priority. Price is negotiable. Delivery in the right place at the right time is not, when it matters most. And that brings us to the divide. There will always be two groups in markets, not the smart and the dumb, not the rich and the poor, the attentive and the distracted. The attentive watch the plumbing, the distracted watch the headline price and assume the rest is fine. When institutions see conversion costs spiking, they don't argue on social media about whether it should be happening. They adjust, they reduce fragile exposure, they secure optionality, they shift to structures that can survive volatility. Retail, by contrast, tends to respond after the move becomes obvious, after the spread is in the headlines, after the margin hikes are widely discussed, after the repricing has already occurred. That's why the information gap becomes a wealth gap. Not because anyone is smarter, but because the data is there for those who look in the right place. So if you remember only one thing from this, let it be this: the gold market isn't one market. It's a connected system of paper claims, physical bars, locations, specifications, and risk controls. When the system is smooth, those differences hide. When the system is stressed, those differences surface as spreads, premiums, and margin moves. And when you see the signals cluster, EFP stressed near $60, margins rising from 16 to 18% in days, and demand flows measured in thousands of tons, the market is telling you something that a simple spot chart cannot. This is Signal and Story, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether the market's plumbing matters. The question is whether you notice it before it becomes everyone's conversation.